biggest market crash in history. Are you ready? Welcome, everyone. Over the next hour, we're going to dissect one of the most consequential questions in global finance, whether the Nasdaq's artificial intelligence boom has crossed from transformative growth into speculative excess. Over the past 2 years, technology stocks have rallied as if the laws of valuation no longer apply. AI became the story that justified every price move. From chatbots to chips, the narrative created its own gravity, pulling in capital, media attention, and political endorsement. Nvidia alone added more market cap in 18 months than the entire UK FTSE index. That's not normal. That's mania scale repricing. But here's the challenge. Narratives can be economically true yet financially false. AI may revolutionize productivity, but the profits might not arrive quickly enough to justify current multiples. Markets live on timing, not faith. We're also dealing with tightening global liquidity, slowing growth momentum, and record corporate leverage hidden behind buybacks and stock-based compensation. All of these factors turn a benign valuation stretch into potential fragility. In today's session, we'll separate signal from noise. We'll analyze data, map scenarios, and translate macro risk into trading implications. The goal isn't to predict a crash, it's to understand the conditions that make one possible and to position intelligently before consensus catches up. Think of this as a stress test for your market assumptions. If the AI cycle truly mirrors the late 1990s internet wave, there's still opportunity, but only for those managing risk, not chasing narrative. Let's begin. Agenda and objectives. Here's the roadmap for the session. We'll start by grounding ourselves in history, because every market cycle leaves footprints. Then we'll examine the hard numbers, valuations, earnings growth, and the concentration of returns. We'll dig into the mechanics of the AI spending boom, the trillion-dollar build-out that's fueling semiconductors, data centers, and cloud infrastructure, and question whether those investments will actually earn their cost of capital. Next, we'll step up to the macro lens. Interest rate expectations, fiscal deficits, and liquidity flows form the oxygen supply for equity multiples. When that oxygen thins, even great stories gasp. We'll also gauge sentiment, retail positioning, institutional hedging, and the behavioral patterns that usually appear just before volatility spikes. Technical analysis will give us objective triggers, because price always confirms narrative fatigue before the headlines do. From there, we'll run 3 quantified scenarios: base, correction, and crash. Each will include probabilities, valuation maths, and potential catalysts. Finally, we'll translate all of this into strategy, practical hedging structures, portfolio posture, and the tripwires you should monitor daily. By then, you'll have a clear mental model of where we are in the cycle and a repeatable framework for adjusting risk. This isn't doomcasting. It's professional preparation, exactly what separates disciplined macro traders from the crowd. The 2023 to 2025 AI boom. Let's set the scene. From late 2022 onwards, artificial intelligence became the beating heart of global equity performance. The technology promised exponential productivity gains, and investors priced those gains as if they were already realized. Nvidia's ascent to a $5 trillion valuation symbolized the mania. Every quarterly report became a macro event. Every product launch moved the entire index. The market started treating one company's guidance as a proxy for global GDP expectations. That's narrative dominance, and it rarely ends gently. Meanwhile, hyperscalers committed record capex to data center buildouts. Analysts extrapolated demand curves straight to the sky. Retail traders piled in via ETFs and options. Institutions followed to avoid underperformance, and passive flows amplified the reflexive feedback loop. Higher prices attracted more buying, which justified even higher prices. Beneath the surface, volatility collapsed. The VXN, Nasdaq's volatility index, drifted toward pre-pandemic lows. Low vol feels safe, but it's often the calm before the storm. It tells us positioning is one-sided. The final accelerant came from policy and media. Governments celebrated AI as a national priority. CEOs inserted AI into every earnings call. Suddenly, valuation discipline vanished. Yet earnings growth, while healthy, lagged the speed of re-rating. Price appreciation outpaced profit expansion by a multiple of 3 to 1. That's not sustainable. As we enter 2025, we're beginning to see the first hairline cracks, slower momentum in semiconductors, cautious tone in hyperscaler guidance, and small upticks in short interest. None of these confirm a crash, but together they suggest exhaustion. Every bubble ends the same way. First disbelief, then denial, then repricing. We're somewhere between disbelief and denial right now. Breadth versus price. The hidden fragility. Let's look under the hood. Despite record-high index levels, market participation has narrowed dramatically. The Nasdaq's advanced decline line, a measure of how many stocks are rising versus falling, peaked months ago. The equal weight version of the index, where every constituent carries the same importance, has badly underperformed the cap-weighted benchmark. What this tells us is simple. Leadership is thin. A handful of megacaps are carrying the market while a median stock is treading water. When leadership narrows to this extent, volatility becomes structurally compressed until it isn't. Passive funds exacerbate the concentration. Every inflow into an index ETF buys the same 7 companies in size, irrespective of valuation. It's automatic leverage built into the system. Historically, when breadth diverges from price, as it did in late 1999 and again in late 2021, corrections follow within months, not years. The market looks invincible precisely when its foundation is weakest. Retail flows are also losing diversity. Retail traders have rotated out of cyclicals and small caps into the same tech giants that institutions already own. That crowding creates what we call liquidity mirage. It looks deep on the way up, but it disappears on the way down. Breadth is the market's immune system. Without it, a single shock can spread everywhere. Unless participation broadens, the next sell-off could cascade faster than models predict. This is the invisible fragility beneath the surface of the AI rally. Historical parallels. Echoes of past manias. To understand today's cycle, we need perspective. History offers an almost perfect mirror. In 1999, investors were convinced the internet would change the world, and they were right. Yet the Nasdaq fell 78% over the next 2 years. The technology succeeded, the valuations didn't. Companies simply discounted 10 years of growth into 2. Fast forward to 2021. Electric vehicles, clean energy, and crypto assets followed the same pattern. Exponential narratives met finite cash flows. Retail enthusiasm collided with tightening liquidity, and prices imploded. Across every mania, the ingredients are consistent. You start with genuine innovation. Liquidity floods in. Analysts extrapolate exponential growth lines. Media stories reinforce optimism. Then comes career risk. No fund manager wants to underperform the benchmark, so they buy what's working. Finally, when expectations reach absurdity, a small disappointment triggers a collapse. The aftermath is always the same. 80% of prices evaporate, but the technology keeps advancing. The dot-com crash didn't kill the internet. It killed overvaluation. The same could happen with AI. The distinction this time is that AI already generates real revenues and cost savings. But visibility remains limited. We don't yet know the true ROI of trillion-dollar data center investments. The real risk isn't technological failure. It's temporal mismatch. Markets are discounting a decade of profit today, but adoption curves rarely move in straight lines. The key lesson: price is not proof of progress. Valuation excess can coexist with genuine innovation. Professional investors must separate the story from the stock price. Those who forget that rule repeat history. So when people say, "This time is different," remind them it never is in valuation space. Only the logo changes. Valuations, priced for perfection. Now we move from narrative to numbers. The Nasdaq 100 currently trades on roughly 27 times forward earnings, near the upper end of its 2-decade valuation band. On trailing earnings, the figure is in the mid-30s. These are the sort of multiples you usually see at the euphoric end of a bull market, not the middle. When we run PEG ratios, price-to-earnings growth, they show that most of the multiple expansion over the last 18 months came from optimism, not earnings. The implied growth baked into today's prices assumes corporate profits will compound around 20% per year for half a decade. That's possible, but improbable. Another way to view it: the total market cap of the Nasdaq now exceeds the annual GDP of the United States by a wide margin. That level of financialization creates a feedback loop. When valuations are this extended, small changes in discount rates have outsized consequences. For example, a 50 basis point rise in real yields, or even a modest risk premium shift, shaves 10 to 15% off theoretical valuations instantly. No shock required, just arithmetic. Add to that the current state of earnings expectations. Consensus forecasts assume double-digit margin expansion and steady pricing power in a disinflationary environment. The odds of all those factors aligning are low. Historically, every time the Nasdaq's forward multiple has breached 25 while earnings momentum plateaued, 1999, 2018, 2021, the following 12 months delivered a correction of roughly 20%. So we're not predicting collapse, we're highlighting asymmetry. Upside from here is capped by mathematics, downside by psychology. The air is thin at this altitude, and gravity is patient. Concentration risk. The Magnificent Seven effect. The second flashing light is concentration. 7 companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, now represent roughly 36% of the entire S&P 500's market value. Yet their share of aggregate profits is only around 20%. That gap means valuation risk is concentrated at the top of the index. Correlation between these names has risen above 0.9. When they move together. Passive ETF flows reinforce this correlation because every dollar entering a benchmark fund buys the same 7 names automatically. On the way up, this creates the illusion of stability. Prices rise smoothly because liquidity is funneled into a few liquid giants. On the way down, it amplifies drawdowns as those same flows reverse. The 1970s Nifty 50 episode offers a cautionary tale. Back then, a handful of blue chips were deemed one-decision stocks. Investors believed you could buy them at any price. It took a 50% drawdown to remind markets that even great companies become poor investments at extreme multiples. Today's index structure makes that dynamic more dangerous. Quant and risk parity funds treat the Nasdaq and S&P leaders as volatility suppressors. Their decline forces mechanical deleveraging across strategies. Diversification looks good on paper, but in practice, everyone owns the same risk. When leadership narrows to this degree, the market's plumbing becomes brittle. One earnings miss or regulatory shock can ripple through every asset class. Concentration is not a sign of confidence, it's a symptom of exhaustion. When the crowd crowds into the same trade, the exit door gets smaller. What must go right to justify valuations? To sustain current valuations, the market needs near perfection across 10 different fronts. First, AI adoption must maintain a global revenue growth rate north of 20% a year. That means companies across every sector must continue integrating AI tools at the same speed seen in 2023 and 2024. Second, operating margins need to expand even as energy, wages, and component costs rise, a tall order. The current profit models assume scale efficiencies that haven't yet been demonstrated. Third, the trillion-dollar capex wave must generate returns well above 10% post-tax. If those returns slip to mid-single digits, the valuation math collapses. Fourth, the competitive landscape must remain concentrated. But we're already seeing open-source LLMs and cheaper chip alternatives nibbling at the edges. Fifth, regulatory risk has to stay dormant. Antitrust actions, AI safety mandates, or energy use regulations could all trim profitability. Sixth, semiconductor supply and demand must remain tight through 2026. Any oversupply event has happened in past chip cycles, with slash margins. Seventh, consumer monetization must arrive. Right now, corporate adoption is strong, but household spending on AI services is minimal. Without that second leg, growth slows. Eighth, the interest rate backdrop must stay friendly. High valuations depend on low discount rates. A single unexpected inflation print can shift the entire curve. Ninth, earnings volatility must remain subdued. Markets are paying a premium for stability that may not persist. And finally, sentiment itself must remain euphoric. As soon as confidence falters, the self-reinforcing loop of optimism and price appreciation unwinds. Achieving all 10 conditions simultaneously is theoretically possible, but history suggests the odds are slim. When perfection is priced in, imperfection becomes profitable for contrarians. Hyperscale, capex boom. Fuel and fragility. The defining feature of this cycle is capital expenditure. Hyperscalers are spending like it's the space race. Goldman Sachs estimates AI-related capex will exceed $1 trillion globally by 2026. That's roughly the annual GDP of the Netherlands directed into one technological theme. GPU shortages through 2024 and 2025 created the illusion of infinite demand. Every major cloud provider rushed to secure capacity, fearing they'd fall behind the curve. As a result, data center power consumption has jumped more than 30% year-on-year, creating new bottlenecks in energy grids and supply chains. For the first time, cloud capex now exceeds corporate share buybacks. Free cash flow conversion at leading hyperscalers has dropped from above 30% to the mid-teens. Debt issuance quietly ticked higher to fund this expansion. On the surface, that looks like visionary investment. Underneath, it's leverage and timing risk. Capex manias tend to overshoot because CFOs extrapolate straight-line demand just as it begins to plateau. Telecom infrastructure in 2000 and shale energy in 2014 both followed that script. Already, marginal returns on incremental AI spending are flattening. The first-mover advantage is diminishing as every player deploys similar architectures. Suppliers are expanding aggressively, risking overcapacity by 2026. The bullish narrative says this is a new industrial revolution. The realist view, it's an arms race that could end with too much steel and not enough demand. If we see even a modest slowdown in data center utilization or ROI on AI workloads, these investments turn from assets into accounting headaches. Markets have rewarded the spend so far, they may soon start asking for profits. Capex is both fuel and fragility. It powers near-term growth but stores potential energy for the next correction. Understanding where we are on that curve is critical for risk management. Capex sustainability and skeptics. Not everyone is convinced this Capex explosion is sustainable. Veteran short seller Jim Chanos recently described the current environment as the most overcapitalized technology cycle since the dot-com boom. His argument is simple but powerful. The expected returns on AI infrastructure don't justify the speed or scale of investment. He points out that once every hyperscaler builds identical data center capacity, the advantage becomes temporary. Margins erode as competition equalizes access to computing power. That's classic commoditization. It happened in fiber optics, solar panels, and cloud storage. Many of today's demand forecasts assume linear adoption curves and endless capital availability. But history tells us innovation adoption is S-shaped, rapid early growth, then plateau. When that plateau arrives, the return on incremental capex drops sharply. There's also a behavioral dynamic. Executive incentives are tied to revenue growth and market share, not necessarily to return on invested capital. As long as Wall Street rewards top-line expansion, CFOs will overspend. Only when investors pivot back to cash flow discipline does the hangover begin. Debt financing adds another layer. Several major players have issued record bond tranches to fund AI investments at rates above 4%, not ruinous, but costly enough to matter if cash flow disappoints. Analysts have started flagging this. Research desks from Bernstein to Morgan Stanley are questioning whether capex intensity above 30% of revenue is sustainable. The historical analogy is the late 1990s telecom build-out, vast sums spent on long-haul fiber that took a decade to monetize. The infrastructure was real, the cash flows weren't, until far later. If the same pattern repeats, we'll see a rotation from growth to balance sheet resilience. Valuations will compress first, write-downs will follow, and capital discipline will once again become fashionable. Capex success doesn't end innovation, it ends illusion. The trick is identifying the turning point before the market admits it. Who's short? Signals from the smart money. To understand market turning points, always follow the positioning data because price tells us what's happened, positioning tells us what could. According to S3 Partners, NVIDIA is now the most shorted single stock in America by dollar value, not by percentage of float. Around $35 billion of notional short exposure sits across the AI complex. That's an enormous insurance policy written by sophisticated players who rarely pay premiums without reason. Michael Burry, the architect of the Big Short, disclosed 1 million NVIDIA puts and 5 million Palantir puts in his Q3 2025 filings. Those are not token trades. They're directional statements that valuations are unsustainable. Jim Chanos, who famously shorted Enron and the dot-coms, has said publicly he's shorting the AI capex illusion, focusing on the weakest balance sheets among the semiconductor suppliers. Hedge funds have quietly built defensive pairs, long regulated utilities, short cyclical tech, effectively neutralizing beta while expressing a view that capital will rotate out of high-duration equities. Meanwhile, options desks report steepening skew in Nasdaq volatility. That means more demand for downside protection relative to upside calls, a classic sign that professional money is hedging while retail remains exuberant. The commitment of traders data tells the same story. Asset managers have reduced net long Nasdaq futures by roughly 20% since late summer. Yet public sentiment, fueled by media headlines and influencer commentary, remains aggressively bullish. That divergence between what professionals do and what the crowd believes is one of the most reliable leading indicators of regime change. Remember, markets don't crash when everyone's bearish. They crash when everyone's long and leveraged, and the smart money's already quietly on the other side. What could break the story? Fragile catalysts. What could actually break this story? Several fragile catalysts are already visible. The first is revenue disappointment. If hyperscalers guide AI revenues lower, even modestly, the market narrative shifts instantly from limitless to finite. Investors tolerate high multiples only while sales momentum accelerates. The second is supply normalization. GPU manufacturers are expanding capacity aggressively. By mid-2026, supply could finally exceed demand. In semiconductor cycles, that's the precise moment when profit margins collapse. Third, export restrictions are tightening. Washington's latest round of chip export controls reduces addressable markets and increases compliance costs. Margins shrink silently long before investors notice. Fourth, energy inflation. Data centers now consume vast power. Higher electricity and cooling costs can eat 200 basis points from operating margins. Fifth, inventory risk. When every firm double orders critical components, the hangover is brutal. Warehouses full of obsolete hardware and forced write-downs. Sixth, narrative fatigue. When every quarterly report mentions AI 50 times, audiences tune out. Once the story stops exciting incremental capital, valuations stall. Seventh, macro repricing. A sustained rise in real yields, say from 1.7 to 2%, compresses discounted cash flows, regardless of growth. Eighth, FX translation headwinds. A stronger dollar reduces overseas tech earnings in reporting currency terms. Ninth, corporate prudence. Boards eventually prioritize free cash flow over moonshot projects, trimming capex budgets and pulling demand from the entire supply chain. And finally, policy drag. ESG pressure and data sovereignty laws impose new costs that investors haven't modeled. Any single one of these factors could spark a correction. A combination could trigger a crash. Fragility is rarely about one big event. It's about multiple small fractures occurring simultaneously. Macro and liquidity environment. Oxygen turning thin. The macro backdrop is quietly deteriorating. The IMF's latest Global Financial Stability Report warns that equity valuations have decoupled from fundamentals. That's institutional language for liquidity is doing the heavy lifting. Global central bank balance sheets are shrinking in aggregate for the first time since the pandemic. The Fed alone is letting over $100 billion roll off every month. Quantitative tightening acts like a slow leak in the asset price balloon, imperceptible day to day, but powerful over time. Real yields remain firmly positive, which raises the discount rate applied to long-duration assets like technology. When the cost of capital rises while growth expectations stagnate, multiples compress mechanically. Meanwhile, fiscal policy offers little rescue. The U.S. deficit is running above 6% of GDP. Europe's fiscal space is constrained. China is stimulus-heavy but credit inefficient. There's no cavalry. Credit spreads remain tight. That sounds good, but it means risk assets have little room for further re-rating. If spreads widen just modestly, the repricing across equities will be nonlinear. Historically, global liquidity contractions have preceded volatility spikes by 3 to 6 months. Think of 2018, when QT triggered a sudden 10% Nasdaq drop in a fortnight. Add to this a strong US dollar. Because global funding is dollar-denominated, a rising USD tightens financial conditions worldwide. Emerging market flows retreat, risk appetite contracts, and the first asset class to feel it is high multiple tech. Money supply data tells the same story. M2 growth has flattened. The correlation between liquidity and equity returns has strengthened dramatically. In simple terms, the oxygen that inflated valuations is thinning. Without new liquidity, every incremental buyer must come from someone else's leverage. That's how melt-ups become meltdowns. Duration and policy risk, the hidden leverage. Every investor in technology stocks is, whether they realize it or not, running a duration trade. Long-duration assets derive most of their valuation from distant future cash flows. When real yields rise, those future profits are discounted more heavily, and prices fall disproportionately. A 50 basis point increase in the U.S. 10-year real yield shaves roughly 12% from the fair value model of the Nasdaq 100. That's not opinion, that's basic discounted cash flow mathematics. The market hopes for rate cuts, but here's the catch: a Fed pivot doesn't automatically mean more liquidity. If the Fed cuts because growth is weakening, earnings expectations fall alongside multiples. You might get easier money but lower profits, a poor trade-off for equities. Inflation expectations remain sticky. Core inflation hasn't convincingly returned to the 2% target, and energy dynamics suggest further bumps ahead. That means policymakers can't flood the system even if asset prices wobble. Passive funds also face a hidden duration mismatch. Many are structured to rebalance quarterly. When yields spike mid-cycle, they lag in adjusting weightings, exacerbating volatility. We've seen this movie before. The 2013 taper tantrum and the 2021 bond sell-off both crushed growth stock valuations despite modest macro shocks. The reason is simple: leverage sits in duration, not in debt. A sudden policy miscommunication, for instance, a hawkish comment during a dovish pivot, could spark a volatility shock. The algorithmic trading systems that now dominate equity flow respond instantly to changes in the yield curve, amplifying swings. In summary, the hidden leverage of this market isn't in balance sheets. It's in valuation duration. Manage that, or it will manage you. Policy and geopolitical shocks, the wildcards. The final wildcards in our macro section are policy and geopolitics, the variables most investors underestimate until they hit. The U.S.-China rivalry over advanced semiconductors is deepening. Export bans on high-end GPUs restrict Chinese data center development and limit revenue potential for U.S. manufacturers. Each new round of sanctions cuts a slice off addressable markets. In Europe, the forthcoming AI Act introduces a stringent compliance framework, risk assessments, transparency rules, data governance audits. These requirements translate directly into cost for any firm deploying AI systems at scale. Antitrust scrutiny is re-accelerating. Regulators on both sides of the Atlantic are probing whether the largest tech firms use vertical integration in AI cloud services to stifle competition. Even without fines, the uncertainty compresses valuation multiples. Data sovereignty laws are another drag. Countries increasingly demand that training data remain within national borders, fragmenting global AI datasets and reducing efficiency, effectively raising the cost of innovation. Energy policy adds complexity. As AI data center electricity demand explodes, governments are debating usage caps and carbon taxes. For power-intensive operations, that's a direct hit to margins. Cybersecurity risk is rising too. AI infrastructure has become critical national security architecture. A major breach could provoke regulatory overreaction and disrupt confidence. Election cycles across major economies bring new populist narratives, proposals for windfall taxes on automation profits or digital levies. These might be politically popular, but market negative. Lastly, ESG pressure is shifting from rhetoric to regulation. Environmental and social activists are highlighting AI's energy footprint and its effect on employment. Compliance costs will rise. Reputational risk follows. Each of these policy factors may look peripheral individually, but together they widen the range of possible outcomes. In valuation models, that means a higher equity risk premium, or in plain language, lower prices for the same earnings. Geopolitics won't kill AI, but it can certainly kill the multiple investors are willing to pay for it. Sentiment and flows, euphoria under the surface. Let's turn to market psychology, the soft data that often matters most. Retail investors remain fully committed to technology. ETF flow data show record allocations to the Nasdaq tracking QQQ and semiconductor fund OXX. Individual investors are now more concentrated in tech than at any time in history. Institutional money is equally one-sided. Growth exposure is 3 standard deviations above the long-term mean. Value exposure sits at multi-decade lows. This positioning amplifies volatility. Once reversals start, there's simply no one left to buy. Options activity adds more color. Retail call option volumes have surpassed pandemic peaks. Traders are speculating rather than hedging. Meanwhile, implied volatility skew is unusually flat, fewer paying up for protection. When downside insurance is cheap and ignored, the eventual demand spike can move volatility indices violently higher. Hedge fund gross leverage has climbed back toward 2021 extremes, fueled by prime broker credit lines and low, realized volume. It's a quiet form of complacency, performance chasing disguised as conviction. ETF flows confirm the story. Roughly $25 billion of fresh capital has poured into technology sector ETFs this year, with less than $2 billion into defensives. It's a textbook late cycle imbalance. Margin debt now exceeds $900 billion, not catastrophic, but high enough that a 10% correction would trigger forced selling through margin calls. Surveys from the AII and Investors Intelligence show bullish sentiment above 80% for tech, levels that historically precede corrections, not rallies. And volatility itself tells the tale. The VIX and Nasdaq's VXN hover near cycle lows, even as fundamentals wobble. Low vol feels comforting, but it's the financial equivalent of thin ice. It holds until it cracks. In short, sentiment is euphoric, positioning is extended, and volatility is mispriced. That's an explosive combination. It doesn't predict when the break will occur, but it guarantees the move will be sharp when it does. Narrative saturation, the hype cycle peaks. One of the most reliable telltales of a maturing bubble is narrative saturation, when everyone is already talking about the same story. Corporate transcripts reveal that AI mentions on S&P 500 earnings calls have risen more than 350% in a year. Chief executives who once discussed strategy or cost discipline now spend half their airtime describing artificial intelligence initiatives, even in sectors where it has little direct relevance. Sell-side analysts reinforce the echo chamber. Nearly 80% of published research on AI carries a positive bias. Venture capital funding mirrors that enthusiasm. 60% of new capital rounds in 2025 are tagged AI-related, often for startups with no clear revenue model. Media sentiment is equally saturated. Mentions of AI boom across major outlets now exceed those of crypto revolution during 2021. Advertising budgets once dedicated to blockchain or metaverse narratives have migrated wholesale to AI. When marketing departments chase the same buzzword as traders, positioning is crowded. Governments have joined in. Policy speeches, budget statements, and parliamentary hearings reference AI as a driver of national competitiveness. That institutional endorsement gives the bubble moral cover. It feels responsible to be long. But public perception is changing. Google Trend data show a plateau and slight decline in searches for AI stocks and ChatGPT investing. The early fascination is giving way to fatigue. When a theme stops generating new marginal buyers, prices lose altitude. Historically, narrative saturation marks the final euphoric phase, a period when fundamentals still look good but momentum silently dies. The irony is that this is often when risk feels lowest. Everyone agrees. Everyone's positioned. And that unanimity is precisely what sets up the break. Technical breakdown risk, cracks in the chart. Charts are the market's lie detector. Right now, the technicals are whispering caution even while headlines still shout optimism. The Nasdaq 100 is up roughly 30% year-to-date, but momentum is fading. The 50-day moving average has flattened, while the 200-day continues higher at a slower slope, a classic sign of fatigue rather than failure. In past cycles, this pattern has preceded consolidations of 15 to 20%. The advanced decline line, our measure of participation, has been diverging from price since July. Breadth deteriorates quietly before volatility erupts. Relative strength indicators show the index in sustained overbought territory. Weekly RSI readings above 70 rarely persist. When they roll over, mechanical selling from quant models amplifies the drop. MACD momentum on daily charts has turned negative, the first bearish crossover since early 2024. That's not definitive, but it warrants attention. Volume analysis adds another layer. Up days are happening on lighter turnover, down days on heavier. That's distribution, smart money exiting while latecomers buy. Support levels between 14.5 and 14.7 thousand on the Nasdaq 100 mark the line between routine correction and structural shift. Below that, stops cascade. The volatility term structure is also showing subtle inversion. Near-dated vol is ticking higher relative to outer months, implying short-term nervousness. Historically, such technical divergences precede sentiment collapses by about 6 weeks. No indicator is perfect, but collectively, they paint a picture of fading internal strength. When fundamentals scream growth but price action whispers exhaustion, always trust the chart. It's the market's early warning system. Breadth dashboard, the fragile foundation. Breadth is the market's foundation. When it weakens, everything above becomes unstable. The equal weight version of the Nasdaq is underperforming the cap-weighted index by more than 15%, one of the largest gaps on record. That tells us gains are concentrated in a few megacaps while the median stock stagnates. Only a quarter of Nasdaq constituents currently trade above their 50-day moving average. In healthy bull markets, that figure is closer to 60. The difference isn't trivial, it's structural fragility. Sector dispersion adds context. Software and consumer internet names are slipping even as semiconductors hold the line. That divergence often precedes a handoff from growth to defensives. Small caps are another warning. The Russell 2000 has lagged large caps by over 20% this year. When smaller companies stop confirming leadership, it signals tightening financial conditions beneath the surface. Defensive sectors, healthcare, staples, utilities, are quietly outperforming on a relative basis. Rotation often begins invisibly. Capital tiptoes out of risk before the headlines catch up. ETF rotation data show rising inflows to minimum volatility funds and profit-taking from high-beta tech. Cumulative advanced decline volume has rolled over for the first time since 2022. Mean reversion indicators, from z-scores to percentile ranks, imply a rotation phase rather than a sustained breakout. That doesn't mean crash, but it means caution. In short, the bull case requires breadth confirmation that isn't there. Without broader participation, every rally becomes self-referential. And in markets, self-reference is fragility. It amplifies shocks rather than absorbing them. Scenario framework, mapping the next 12 months. With the evidence assembled, let's map realistic scenarios for the next 12 months. Base case, 50% probability. The market digests its gains. Earnings expand modestly, perhaps 8%, while price/earnings multiples drift lower to the mid-20s. AI investment continues, but enthusiasm cools as ROI timelines lengthen. The Nasdaq experiences a contained drawdown of 10 to 12%, finds support, and trades sideways within a wide volatility band. Vol remains elevated, but controlled. Correction case, 35% probability. This scenario sees breadth fail decisively and capex growth decelerate. Valuations re-rate to roughly 23 or 24 times forward earnings, consistent with historical means. That implies a 15 to 25% index decline. Capital rotates out of speculative tech into defensives and dividend payers. Volatility spikes temporarily. Policymakers reassure. Markets stabilize mid-year. Crash case, 15% probability. Here, a macro shock collides with an AI capex retrenchment, perhaps a yield spike, geopolitical flare-up, or corporate funding squeeze. Margin calls propagate through leveraged ETFs and structured products. Passive outflows accelerate. The Nasdaq falls 30 to 40% peak to trough, echoing 2000 or 2022. Policy support arrives late. Valuations overcorrect before rebuilding. Notice the asymmetry. Upside from here is limited to high single digits. Downside risk remains double digits. That's not pessimism. It's risk math. For traders and allocators, the takeaway is to frame decisions around probabilities, not narratives. The base case justifies selective exposure, not blanket optimism. The correction case demands active hedging and reduced leverage. The crash case requires preemptive contingency planning, liquidity, diversification, and clear stop-loss protocols. Every investor must ask, what if the base case is wrong? Because when everyone assumes soft landing perfection, the probability distribution itself becomes skewed. Professional risk management lives in that skew. These three scenarios will anchor the rest of our discussion as we move next into strategic positioning and hedging frameworks. Derating math, quantifying the downside. Let's translate valuations into arithmetic. At roughly 27 times forward earnings, the Nasdaq 100 is trading about 6 turns richer than its 5-year average. That gap might sound small, but in index terms it's huge. Each single-point contraction in the multiple knocks roughly 4% off price. If the multiple reverts to a still healthy 23 times, perfectly normal for a mature growth cycle, the index would fall about 12 to 15%. At a modest earnings downgrade of 5 to 7% as margins normalize, and you arrive near a 20% total correction. No drama, no panic, just gravity. Real yields compound the effect. Historically, every 10 basis point rise in real rates trims roughly 2% from Nasdaq fair value. If 10-year TIPS yields move from 1.8 to 2.3%, that's another 10% valuation drag. These are mechanical repricings, not emotional ones. In dollar terms, each $1 trillion of market cap erased equals about 4% on the index. It doesn't take many trillion-dollar giants misstepping to move the tape meaningfully. The uncomfortable truth is that the margin of safety has vanished. Prices embed perfection. Earnings merely need to be good to justify it. But good isn't good enough when the world has already paid for great. Upside from here, based on optimistic assumptions, is perhaps 8%. Downside on basic valuation math alone is 2 to 3 times that. The risk-reward skew is negative. This isn't a forecast. It's probability weighting. Valuations are like altitude. They don't tell you when a plane will descend, only how hard the landing might be. The higher you fly, the thinner the air, and the less margin for turbulence. We're flying high. Portfolio posture, playing defense without retreat. Late-cycle investing isn't about hiding. It's about calibrating risk. We want portfolios that can absorb volatility without surrendering opportunity. Start by holding a liquidity buffer, 10 to 15% of capital parked in short-duration bills or money market funds. Liquidity is optionality. It lets you buy when others must sell. Next, adopt a barbell. On one side, own the picks and shovels of the AI revolution, chip equipment, data infrastructure, and specialized software that generate positive free cash flow today. On the other, own defensives, utilities, healthcare, consumer staples. That combination captures upside while cushioning shocks. Prioritize free cash flow yield over abstract growth stories. In tightening liquidity, cash generation trumps narrative. Reduce dependence on single-factor exposure, especially the megacaps that dominate indices. Even trimming weights by a few percentage points meaningfully lowers correlation risk. Within equity sleeves, tilt toward quality dividend growers. Their compounding provides real return while you wait. Manage duration. If you hold long-dated bonds or high-duration equities, balance them with shorter assets. Duration, not direction, is what kills portfolios when yields move. Keep FX exposure neutral. Historically, a stronger dollar accompanies equity drawdowns. An unhedged foreign allocation can provide natural ballast. And always budget for hedging, roughly 1% of assets each quarter. It's the cost of staying in the game. The aim isn't heroism, it's endurance. Markets reward those who survive volatility long enough to exploit it. Hedging menu, practical structures for protection. Hedging isn't bearishness, it's professionalism. It's paying a small premium to neutralize catastrophic outcomes. For broad market protection, use QQQ debit put spreads. Buy a put about 5% below spot and sell another 10% lower same expiry. You cap cost, define risk, and capture the sweet spot of volatility convexity. For targeted exposure, NVIDIA long put calendars are effective. Buy a longer dated put, sell a near-term one ahead of earnings. This structure exploits time decay and post-earnings volatility spikes without large upfront debit. To hedge the semiconductor complex, combine SOXX puts with long exposure to regulated utilities, a natural negative beta pair. Cross-asset hedges work well in liquidity shocks. Long US dollar to Japanese yen or long treasury bond calls historically appreciate when equities fall. For volatility purists, buy short-dated VXN calls. Think of them as seat belts. They lose value when the road is smooth but save you in a crash. Advanced managers can run dispersion trades, short index volatility, while long single-name volatility. When correlations rise during sell-offs, this structure monetizes the widening spread. For pure tail insurance, Consider deep out-of-the-money S&P puts with 3 to 6 month tenor. They're cheap when nobody wants them, priceless when everyone does. Execution discipline matters. Add hedges when implied vol is low, VIX below 20, not above 30. It's about buying umbrellas before it rains. Keep premium outlay within 1% of AUM per position, and review monthly as the volatility regime shifts. Effective hedging transforms uncertainty into strategy. It lets you hold conviction positions without sleepless nights. Tripwires to act, signals that precede regime change. Professional risk management isn't reactive, it's conditional. You define triggers in advance, so emotion never drives execution. The first tripwire is breadth divergence. When the advanced decline line underperforms the index by more than 5%, the market's internal strength is decaying. That's when to raise cash, not when the headlines turn negative. Second, CAPEX guidance. If hyperscalers trim investment plans by 10% quarter-on-quarter, the AI capital cycle is cooling, a major narrative inflection point. Third, short interest spikes in NVIDIA or semiconductor ETFs. When sophisticated investors pay to hedge, follow their lead. Fourth, a decisive 200-day moving average break on the Nasdaq 100, more than 3% below. That's the threshold where systematic funds de-risk automatically. Fifth, volatility term structure inversion. When near-term VIX futures trade more than 5 points above the next month, fear is entering the system. Liquidity will shrink. Sixth, an acceleration in the Fed's balance sheet reduction beyond $120 billion per month. That's a hidden tightening nobody models. Seventh, credit spreads widening 75 basis points from their lows. Equities always follow credit, never the other way around. Eighth, consecutive retail ETF outflows. Retail investors provide the marginal bid. When they withdraw, momentum evaporates. Ninth, the USD index above 108. Strong dollar regimes coincide with global risk-off phases. My rule: if any two of these signals flash simultaneously, activate hedges immediately. Don't debate, don't wait for confirmation. Prevention beats prediction. Risk controls, staying alive through volatility. Every professional trader knows risk control is the business. Everything else is marketing. Begin with option discipline, cap hedge losses at 50% of premium. If protection decays beyond that, recycle the capital, don't anchor. For unhedged positions, enforce a hard 8% stop from entry. Stops aren't weakness, they're cost control. At the portfolio level, maintain value at risk below 2% per day at 95% confidence. If volatility spikes, automatically reduce gross leverage until you're back inside limits. Rebalance monthly. Overweight winners quietly morph into unintended bets. Limit single-name exposure to 5% of capital. Even safe megacaps can have in stress conditions. Run stress tests for a 20% index shock and verify liquidity. How much could you liquidate in a single session without moving price? If the answer is uncomfortable, trim positions before the market forces you to. Perform correlation analysis. Many investors think they're diversified until they discover everything they own falls when the Nasdaq sneezes. True diversification means different cash flow drivers, not different tickers. Document exit criteria before entering trades. The moment a position is justified by hope rather than data, discipline has failed. Remember, survival precedes success. The traders remembered after every cycle aren't the ones who predicted crashes, they're the ones who never blew up. Protect capital first, profits follow. Executive summary: from euphoria to discipline. Let's conclude with clarity. The artificial intelligence revolution is real, but the market's pricing of it is euphoric. Valuations have detached from fundamentals, breadth has narrowed, and liquidity is quietly evaporating. Macro conditions are shifting against high-duration assets, positive real yields, persistent fiscal deficits, and limited policy flexibility. Add geopolitical and regulatory noise, and the risk landscape broadens. Upside potential for here is incremental, downside remains exponential. That asymmetry demands respect. Protecting capital is generating performance because preserved capital compounds. The investor who loses 20% must earn 25% just to break even. Avoiding the drawdown is alpha in its purest form. Use hedges strategically, not reactively. Think of them as operational expenses, insurance that lets you pursue opportunity while others retreat. Focus capital on companies producing real cash today, not promises tomorrow. Favor strong balance sheets, disciplined governance, and transparent accounting. Fundamentals may be boring, but they survive storms. Manage duration consciously in both equities and fixed income. Match asset horizons with funding needs. Don't borrow short to bet long. And above all, practice process discipline. The new alpha isn't forecasting, it's consistency. Anyone can ride a bull market. Few can navigate the transition out of one. We are standing at that transition. Whether it becomes a gentle correction or a sharper reset will depend on liquidity, policy, and psychology, forces no one controls. What you can control is preparation. Stay liquid. Stay rational. Stay profitable. If you've made it this far, you already understand something most traders don't. Markets don't reward noise. They reward preparation. At Traders MBA, we don't just talk about risk, we track it. Every day, across macro, sentiment, and technical regimes. Our team publishes real-time positioning, trade setups, and macro dashboards inside Insights Pro, the platform built for traders who think like strategists. It's where you see exactly how we're navigating the same volatility we've discussed today, before the headlines, before the herd. If you want to follow the trades we're taking, the precise entries, exits, and macro rationale, join Insights Pro. You'll get direct access to our trades, risk-on, risk-off models, and strategy briefings. Because in this environment, you don't need another opinion, you need a process. So the next time markets panic, you're not reacting, you're positioned. Join Insights Pro today and trade the truth, not the noise. Thanks for watching.